All right, let's dive into the strategic story of Bharat Forge. We're going to break down how it's transforming itself from what was, a pretty standard cyclical auto parts supplier into a much more diversified defense and engineering heavyweight. This is a really fascinating look at a company fundamentally changing who it is and how investors see it.
So here's how we'll tackle it. First, we'll look at what makes Bharat Forge a new defense powerhouse. Then, we'll walk through the strategic pivot that got them there. After that, we'll weigh the bull case against the bear case, and we'll wrap it all up with the final verdict on its structural re-rating.
Okay, so the most important thing to get right off the bat is this. Bharat Forge has fundamentally changed. The company we're looking at today is just not the same one that investors have known for the last few decades. And this image really tells the whole story, doesn't it? It shows the journey from being just an auto-cyclical business, totally hostage to the ups and downs of the market, to becoming a defense compounder with a totally different, more stable growth path. The real takeaway here? It's now a diversified engineering firm that can generate sustainable, standalone margins of over 27%. And that kind of stability, well, that's the real game changer.
So the big question is, how did this actually happen? Well, it definitely wasn't an overnight switch. This was a deliberate, multi-year transformation that completely reshaped the entire business from the ground up. To really get the pivot, you have to look at where they were. After the pandemic, their traditional business was super dependent on the North American truck cycle. And as you can see, that cycle had pretty much peaked and was starting to stagnate. This reliance on one cyclical market was a huge vulnerability for them. And here, right here, is the solution. This is what we call the defense inflection point. By fiscal year 2025, defense revenue shot up to become a double-digit chunk of their total sales. This created a really powerful counterbalance to the auto cycle and fundamentally shifted their whole business model away from that old dependency.
This timeline just lays out the story of their execution perfectly. You see the auto cycle peaking, then boom, defense contribution grows in FY25. By January 2026, they're locking in major defense orders, which leads directly to killer Q3 results the very next month. And the result of all that? The stock hits record highs in March. It's a really clear cause and effect story.
So all of that brings us to the bull case. What are the main arguments for why the company could keep outperforming? Well, it really boils down to two very powerful engines of growth.
Let's start with this number because, honestly, it's the anchor for the entire bull argument. 11,130 crores. That's the size of their current defense order book. And to put that number in perspective for you, that order book is up a staggering 102% from the year before. I mean, that provides an incredible amount of visibility into future revenues, mostly driven by those huge contracts for the ATAGS artillery system and the CQB carbines, which are really starting to ramp up now. And here's that second engine. See, the bull case isn't just about defense. It's about combining that massive defense contract execution with a recovery that's predicted in the North American truck market. When you get both of those engines firing at the same time, you get this incredible double-engine growth scenario. Now, from a purely technical standpoint, it looks like the market is buying this story big time. The stock has broken through a major historical resistance zone right around that 1350 level. And that last monthly candle, it's a massive bullish Marubozu. In simple terms, that signals absolute total dominance by the buyers and really strong institutional conviction. It's like the market giving a huge yes vote. But of course, no good analysis is complete without looking at the other side. So what are the potential headwinds? What could possibly challenge this very bullish story? So the main risks really come down to execution. For example, what if the destocking in the US vehicle market lasts longer than everyone expects? Or what if defense regulations cause unexpected delays? And this is a big one. The stock's current valuation is so high that there's basically zero room for any kind of earnings mess. And beyond just execution, you've got external pressures. Any softness in international passenger car markets could be a drag on the legacy side of the business. And even more important, volatility in raw material costs is always a threat to those great margins they've been posting. Plus, a high PE multiple on its own just creates this constant pressure to be perfect. The technical chart is also flashing a little bit of a near-term warning sign. The Weekly Relative Strength Index, the RSI, is getting up close to 80. Now, in the Indian market, that often means a stock is getting overheated.
It suggests a higher risk of investors deciding to take some profits off the table, or maybe just a period of consolidation to let things cool down a bit.
So you weigh this powerful bull case against some very real risks. Where does that leave us? What's the final verdict from the source report?
I think this quote just nails it. The central conclusion is that Bharat Forge is simply not the company it used to be. This isn't just a temporary upswing in a cycle, it's a deep, fundamental transformation into a structural compounder, and that kind of change warrants a complete re-rating of how it's valued. The company's financials really back this up. I mean, with a net debt-to-equity ratio of just 0.15x, their balance sheet is absolutely rock solid. This gives management incredible flexibility to expand or make acquisitions in the future without taking on a bunch of risk. And because of that underlying strength, the analyst recommendation is to see this current breakout as being fundamentally driven. So for long-term investors, the suggested strategy is to accumulate on dips. Basically, use any of those short-term pullbacks, maybe from those overheated technicals we just saw, as a chance to build a position. Which really leaves us with the million-dollar question, doesn't it? Has Bharat Forge actually, truly escaped the gravity of its old cyclical past? Or, even with this amazing defense pivot, are the risks and the volatility of its old self still hiding somewhere inside its new, much, much higher valuation? That right there is the core question for any investor to think about.